Welcome to Daily Fortune, where we talk about the latest topic about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so that you'll know when I upload new videos. Now, let's get started. According to Cathie Wood, recession has been one of the biggest worries. Though the market has continuously increased in terms of value, investors are still pressed on the recession that's about to happen, and many have been dreading for us to occur for the past years. There are data and statistics that would confirm such a claim in ways bigger than we can imagine. Cathie Wood has foreseen the presence of hindering technologies, the current commodity disruption, and something that may be unexpected to happen. Cathie has also foreseen that there are trends that may cause anxiety and panic to some investors and eventually lead to recession due to several reasons and factors that many people least expect. Cathie has pinpointed that the next occurrence to occur is the downfall of the economy due to numerous reasons. By watching this video, you will know more about its indicators and the serious problems ahead of it. So buckle up and let us all see the possible events to occur in the world economy. To kick off, let's talk about the pandemic, which paved the way for these economic problems to arise. Due to the pandemic, many industries have been severely affected and might still be affecting many people and businesses up until now. Many supply shortages happened, which led to inflation rate or the dramatic increase of price, and supply chains just couldn't cope up with the sudden alterations. However, the aftermath of the sudden decrease in demand may also affect the overall status of the economy, which may lead to abrupt recession. One of the most significant examples for this would be the chip shortage, which affected every related company in one way or another, while supply chains are still being rehabilitated due to the pandemic-driven issues. This instance has increased the price of chips to new heights, which is something unexpected, but it's actually just a parcel of a much bigger cycle that often occurs with chips. The chip cycle is working really simply. Firstly, demands for chips elevated in a short span of time, which would also affect the supplies and the supplier's decision because there would be a need to increase production, otherwise there would be an imbalance between demands and supplies in the market. New production plans will then be made, which would take 17 to 24 months, long enough to wait for the consumer demand to appease. This would lead to lesser demands from consumers, while supplies would begin to increase because chips last for long and don't need to be replaced often. This means that in the time when there are more supplies already, people may not yet opt themselves to buy new chips because they don't need it, resulting in higher supplies but lesser demands, hence a surplus. On this event, demands would go down and prices would do the same as what the law on demand and price implies, which directly means that lesser production would be made since demand would not be advantageous to the market. While manufacturers cease the production of chips, people would then start looking for it since they would need to replace their chips, which would lead to the same process. This event would occur over and over again on a normal economic status. In other words, when people start having low demands for chips, and when mass production is over, there will be excessive supplies. However, we are in a different situation. AMD CEO Lisa Su mentioned that this situation is never new to us, since we've experienced this up and down cycle where demand has exceeded supply or the other way around. But with the presence of the pandemic, things aren't the same because it has magnified the cycles to the extent that it has become severely unanticipated levels. Commonly, what comes up should come down, but the worst situation is that this does not only affect the chip industry, but also the entire economy. From the fact that the pandemic has affected all aspects of business, many industries have been suffering from the same predicament. For instance, in the basic goods or necessities, due to the pandemic, people have stocked up in their shelves at home, resulting to lesser supplies in stores. But due to the decline of the pandemic, many people could switch from goods to services, which is an alarming stage to big and wholesale suppliers. As a whole, there are many suppliers who are massively impacted because demands in any aspect have risen up and not a lot of goods are available. However, suppliers are starting to be in panic since demands are also starting to slope down since people have secured their goods already. This simply conveys that since suppliers have excessively produced goods to stabilize the number of goods in the stores during the pandemic, where there's a huge demand and now the pandemic is starting to be in loose, supplies in the stores may be untouched, resulting to a decrease in sales, affecting revenues of course. Shortage of chips would likely exit the scene in the following year. Su mentioned that it may take 18 to 24 months to have a new plant and even longer depending on the situation than these investments were started. A year ago, Lisa's approximation, the increase on the production of chips would be seen in 6 to 12 months. On the other hand, Cathie Wood knows that the scarcity of supplies is happening real time, but there are some indications that the cycles are affecting other aspects. This shortage of supplies is not only happening to chips, but also to other goods, most especially that suppliers are going downwards with their production. This shortage would affect all goods, be it chips or other goods. This is such a worrying state to all investors, since it may lead to a sudden recession. Cathie thinks otherwise because instead of a consistent recession, a correction may happen, which means that we should not expect that there would be a 90s crash or anything leading to the drag of the correction. Buildup of inventories is also happening, and we've been emphasizing for some time that inventories in the system are much higher than what people may be fond of. But where are the inventories? Are they somewhere in the store that we can buy? Somewhere in the shelves that we can purchase? No. They are in households, stored and kept hidden. People keep their supplies for themselves, and many of those supplies would last them for quite some time. But since it is supply chains that we're talking about, this would be given solutions eventually. The simultaneous slowing down of the economy and the inventories at home shows that what we will experience in the years to come is deflation, far from inflation. For instance, in car-related situations, there are chances of oil going up in price, but there is less utilization of it, as well, most especially that most people are working at home. We do shopping and everything at home as well, so there's no need to buy gas. This means that the prices do not directly have an impact on us because we don't consume those goods on a regular basis. Another example would be the increase of price in car accessories, which can affect you if you own one, but if otherwise, there would be no direct or vivid impact to you at all. We are completely aware that we are in the peak of the cycle for durable and feeble goods, but the entire consumer spending is not directly exclusive and would not lead us to the endgame where consumers spend more money on services, like at restaurants or traveling. In this case, people start spending on these businesses, leading to their recovery, but spendings on goods decreases. Hence, a cyclical deflation, not correction. On goods and services to be particular, some signals of microeconomics are viewed by Cathie Wood, which she discusses in the next clips.
And if we're right, we're probably going to be seeing some surprising stories about inventories out there at stores, because we do believe that there has been a lot of double and triple ordering. And now that the consumer is shifting away from goods at the margin to services for obvious reasons, we're vaccinated, we're out and about now, there will be too much inventory, we believe, on the shelves. We're beginning to get some rumblings of this week. Kohl's and Bed Bath and Beyond were hit hard. And I do believe, and one of the reasons were downgrades, I think analysts are beginning to sniff out this excess inventory and the loss of demand as consumers move from goods, at the margin, of course, to services.
So that's it. Cathie Wood and her prediction that the next big problem would be a recession. She immensely believes in the building of own consumer inventories, and by itself would cause deflation glitches in goods in short-term companies, which are commonly supply constrained. Hence, with the decreasing demands of goods, supplies might overflow since people are switching from goods to services. However, this may be considered as an issue for huge companies who sell abundant goods, because with lesser demands, there would be more surplus. With all that being said, this correction would bring wide economic devastation. Let me know your thoughts about this prediction. Are you worried? Indifferent? Well, let me know how you feel. Cathie has assumed a lot of futuristic events and made various theories, but this one is radical. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, please don't forget to hit the notification bell. See you next time!